Hi, I'm Midas. Welcome to the quarterly return update. In this video, we're going to go over the returns of all the general capital markets in the second quarter of 2022, as well as covering my own portfolio returns and an overall overview of my portfolio's contents at the end of the second quarter going into the third. This is only the second video in a series planning to do this type of content each quarter at the end of each quarter. So if you missed last quarter's video, you can check that out. I'll try to have that on screen right now. If you're new to the channel and you like what you see, please give us a like and subscribe if you're not already. That way you get notified whenever we go live. And perhaps join the Discord. You can find the link in the description below. So first off, we're going to discuss the treasury markets. And I made actually a small adjustment to the way I was calculating one part of the treasury markets compared to the first video I did, which is in the tips rate, the green line you can see on the left-hand side there. I made an adjustment to try to more accurately represent the changes in the expected returns for the tips as the CPI changes. Either way, as I had said in the last video, it is kind of arbitrarily non-volatile compared to the other yields that you can see on there. That just has to do with the way the calculation is going at the expected returns based off of the CPI. But either way, looking at it, you can see that the yields moved upward overall in line with the movements that we saw upward in the first quarter, and that made the overall returns of each of the yields move downward as well. Though you can see that the overall return of the 10-year treasury is actually now higher than the return of the 3-month treasury or the 2-month treasury, which is very interesting to see considering the changeover in yields, and that has to do with the yield inversion. And taking a look at the rest of the bond market as far as the corporate yields, it's basically more of the same, with yields moving up pretty significantly in all categories, and the overall returns respective to those categories also going down in line with that. High yield now in very, very strong bear market territory, actually much worse than even the equity markets, while at least most of the investment grade markets are maintaining a level that puts them at least in a better position than a lot of the equity markets. And taking a look at the rest of the sovereign bond returns outside of the treasury around the globe, also more of the same, with the developed markets moving downward into a very strong correction territory, with the emerging markets still outperforming relatively speaking comparatively, but still in correction territory. And then as with the previous video, we also have the currency returns on the right hand side, a grouping of currencies that are relevant to me being the ones that are trailing downward, and then the DXY is the index for the dollar, which is a little bit more representative of the entire currency movement, showing that indeed the dollar has continued its movements upward in the second quarter as well. And this chart, which I introduced in the last video, which I noted is very important, kind of key chart in my mindset, which basically breaks down all these different bond market aspects and by type, by combining them together and stripping apart different sections of the yield as related to different sections of the market. And you can see that the real risk-free rate, which is basically the portion of the risk-free rate that is adjusted for inflation, has moved into positive territory in the second quarter, which is good. Real risk-free rate you would kind of hope would actually be in positive territory in general. And then one thing I had also talked about in the last video is that the time premium, which is the yellow section we saw disappear towards the end of the first quarter, it reappeared in the second quarter and then has disappeared once again. Whenever the time premium disappears like that, that's the yield curve inverting, and that basically is an indicator that people are more concerned about the short term than they are about the long term, which is indicative of a recession. So taking a look at the commodity returns, compared to where we were at the end of the first quarter, there's a little bit more of a wider spread compared to as far as like in the last quarter, that was mostly everything up. And now that some things are in correction territory. Bitcoin is down pretty significantly. As you can see, lumber has come down pretty significantly. Wheat is actually also trailed downward. And then natural gas and oil have both had their corrections as well over the last couple months, while many other of the commodities are also kind of flying the middle line there. And I also haven't gotten any updates on pork, which is why you can see that line kind of dropping off in the middle there. Overall, though, commodities are still up on the quarter a little bit. So taking a look at the main benchmarks that I like to compare myself to in my own investments, the S&P 500 being, of course, the main one, but I like to take a look at all 5 of these because I think if all 5 of these indexes effectively account for well over 99% of the entire equity markets globally. We have the S&P 500 being large cap and mid cap in the United States, then Russell 2000 being small cap in the United States, then developed and emerging markets both being representative of large and mid in their respective geographies, and then foreign small cap being representative of essentially the rest. As we can see, everything's moving pretty orderly and downwardly together in a nice little smooth kind of bumpy fashion. You can see right there. As we've kind of already noted, emerging markets are outperforming developed markets in equity markets as well as in the bond markets, which is very interesting to see. Though we can also see that small caps are in general dealing with the most pain globally as well as domestically. And then taking a look at some derivative indicators that I like to watch, that being the VIX volatility index as well as the put to call ratio. Compared to the last video I made, I actually switched the put to call ratio to be the 5-day moving average of it because the put to call ratio tends to be very, very volatile. And looking at over a 6-month period, I was just like, yeah, this isn't really very useful to look at because of how much noise there is in it. So I was like, let's actually do the weekly average to kind of get an idea. And indeed, you can kind of see the co-movements. It's like put to call ratio doesn't move up too drastically too quickly, but indeed both the VIX and the put to call ratio are elevated to relatively to where they were in the first quarter, though the VIX had some spike up points in the first quarter. And then taking a look at the U.S. markets disaggregated by sector, we can see how I kind of noted that the global equity markets were in a nice orderly climb because of just how smoothly they are all moving together. This is a different type of organized in the sense that you can see that the decisions that were made relatively early on in the first quarter about like which industries were going to need correction more than others, we can see basically more of the same. It's all consistently keeping in trend with it. That being that technology and discretionary and communications are all there at the bottom of the chain, dealing with the most pain, even more so than in the first quarter, as well as energy still being the massive outperformer of the year. Though if we only looked at the second quarter, they wouldn't be an outperformer, but that's fine. This is the yearly return that I'm trying to kind of look at the 2022 returns in general. But then the types of industries that we often see do relatively well in kind of recessionary environments are still relatively outperforming. Like healthcare is doing relatively well, as well as like staples and things like that. So I would call this a pretty well organized decline where it seems like everybody understands what type of environment we're in, and so everything is trading according to what you would generally expect in the environment. So taking a look at my overall returns on my portfolio, comparing it also to what the returns we had in the first quarter. In the first quarter, I had a little over 2% for my quarterly return, and that compared to the S&P's decline of just under 5%, which brought my cumulative CAGR to 18.61% per year since I started investing. That is on a dollar-weighted compounded basis. And my expected 5-year return at that point was about 12%. And that's against the benchmark CAGR that I have for basically the S&P 500, assuming if I had invested in the S&P 500 at the same time that I was depositing money. So it's a dollar-weighted comparison. And also compounded accordingly, reinvested all dividends. That would have made the compounded at that point 21.43%. And my expected 5-year CAGR at the end of the first quarter was 7.16% for the S&P 500. And then the return ratio at the bottom, 0.87, that's effectively the ratio between my cumulative CAGR and the benchmark's cumulative CAGR, showing that I was indeed underperforming the expectations essentially by a factor of essentially 0.13 or so as a ratio. Now, here we are at the end of the second quarter, which is in the current column. Indeed, man, what a rough quarter, down almost 17% on the quarter. That brings my cumulative CAGR over my entire investing career down from the 18.61% down to 10.78%. And my expected 5-year CAGR has shot up, which makes sense considering the portfolio has moved down from 12.1% to now 19.89%, which, I was trying to aim for 20% type returns. That's kind of what, you always kind of want to hope when you're a stock picker. People typically aim for that or higher or something because of what the best investors typically have gotten. So the fact that even when I was doing relatively well, I was only projecting 12% because I knew that the market was overvalued, and I was still calculating that accordingly, just by company, and not like making any random things up. It's like that number comes from my calculations based off of the companies that I have in my portfolio. I don't just make that number up. It's like it's done by company basis. Then we just add it all up together. But now it's shot up to 19.89%, showing that indeed the market's declined. I've readjusted my beliefs about a lot of those companies, but even so, the expected returns are expected to be higher. Now, comparing against the S&P 500, the S&P was also down about 16%. So I did do worse than the S&P in this quarter by almost a full percent. We did outperform by a pretty wide margin last quarter, about by over 7% last quarter. So underperformed by 1% this quarter. I consider that okay, altogether. That brings the benchmark CAGR for the S&P 500 from the 21% down to 12, almost 13%. And then the expected 5-year CAGR for them has jumped up as well to 8.8%. So obviously their expected returns have moved upward, but mine have shot up much higher. So now I really expect to do better than the S&P 500, which of course that's what every portfolio manager says after their portfolio has gone down, of course. But I think I at least have well-grounded valuation reasons for believing that. That did bring my return ratio compared to my benchmark down from the 0.87 to 0.84. But it's worth noting that in the fourth quarter, it was at like 0.76. So we're still making up for the lost ground that we had in our early part of our career when we were definitely less knowledgeable about what we were doing. And taking a look at my returns over the long run, I didn't have this chart in the last video. I had some other videos that, or some other images that I decided to replace with these ones. This is my portfolio as a cumulative return. On the left-hand side, you can see the blue line is my portfolio, and then the red line is the total return index. And then the orange line is adjusting that total return index for that dollar weighting effect, as I was saying, like if it was the same deposits on the same days. So you can see my portfolio compared to the index. I am indeed, over the long run, currently underperforming them, but the gap that existed for about a year and a half or so has started to narrow. So I feel at least reasonably better about that. And then on the right-hand side, you can see the annualized per year return of basically the same information. The orange line being the same dollar weighted CAGR for the benchmark, but the deep blue, dark blue line being basically the same thing for myself, because when you're looking at a yearly CAGR, you could also take into account the dollar weighted CAGR itself. Basically, kind of taking into account whether or not you thought of my returns as like a security that you invested on a yearly basis, or if you thought of it as a fund that you invest as a dollar cost measure. Basically, two ways to measure your returns effectively. So taking a little bit of a close look at my returns and breaking it apart by category, which is something I showed also in my last returns video, getting an idea of just like how the turnover in my portfolio relates to the returns I have. The return that I had over the quarter, we can see is basically the endpoint there with the green, pretty solidly in negative. This isn't actually the quarterly return. It says quarterly return, but I need to change the word on there. This is the keeping track of the year to date. So year to date, a little over 10% down on net. Overall, you can see that we have collected a decent amount of dividends, but we also have paid some option premium. I've collected some options and paid some option premium on net. I've paid a little bit down on option premium. We've also bought a lot of assets and sold some assets. So if you basically take all those real cash flow items into account, the actual turnover in my portfolio, and add all of those things together, and then compare it to the actual return I have, there's this gap between the two, which effectively makes up the market value difference. In the first quarter, the market value difference showed that technically there was a small downward movement. In this quarter, it's actually more of an upward movement. Basically, what that kind of points out, it shows whether or not the market moved down more than you when you were selling more than buying, effectively meaning that you were going to safe havens and then the equity market went lower than you, versus whether or not you were buying into a downward market. It doesn't really make a huge difference. Like I said, it's just this is how I like to keep track of my portfolio turnover as the year develops. So taking a look at my portfolio in a little bit more detailed characteristics as it currently stands. At the end of the first quarter, we had 25 total positions, and we still currently have 25 total positions. That's not 25 total securities, it's positions. So for a couple of things, I actually have like a couple things together considered one position. Whether or not certain things are hedged together or not, that's just kind of how I like to think about things. But either way, it's 25 positions. The concentration has not changed too much. I am slightly more concentrated now than I was at the end of the first quarter. We moved up about 1% in concentration, about almost about 36% in the top 5 of my positions. And then the ending cash position at the end of the first quarter, I was actually slightly on margin at the end of the first quarter due to some portfolio dynamics I was working through. I kind of explained that in that quarterly video. But now at the end of the second quarter, it shifted upwards to about 12% cash. It's worth noting that when I say cash in this case, it's not actually necessarily literally portfolio cash, because I also have some cash equivalent type items in my portfolio. And so this is effectively a balance between the two. So effectively discounting a certain liquidity effect, how much actual cash do I think I essentially have on hand. And the same thing goes for when it said -1%, sort of the same logic. So either way, -1% to 12%, we've increased our cash position rather drastically, that being the ending cash position. Now, I also like to show the average cash position during these time frames to show that, you know, whether or not one thing is on one day isn't necessarily representative of how things are over the entire time frame. The average cash position that I had in the first quarter was just under 4%, and then now it's over 5% in the second quarter. So you can see that the fact that it's up to 12% is kind of more of a recent fact, essentially is what that kind of could imply. And then I also have a cash target based off of certain market dynamics and where I think the value of the index is. And my cash target was about 15% at the end of the first quarter, and it's now almost 18%, which is part of the reason I like to engage in certain equivalent items or hedging positions or certain other types of things to allow me to have different types of liquidity under different circumstances. That effectively allows me to sort of have more cash than I really have, if that makes sense. That may not make sense to some, but that's just the way it is. And we also keep track of our beta. In my last quarter update, I did actually have my beta calculated on a daily basis, partially because I would have preferred to have that on a weekly basis, but I didn't have enough daily portfolio return data on my my overall portfolio up through enough years to actually do that. I've had my portfolio for under 4 years now, but I haven't been keeping track of as much data as I do now for only about 2.5 years. So that, you know, I only have so much data for certain time frames for certain things, but I've effectively switched over my beta tracking of my portfolio from a daily return to a weekly return to your weekly rolling beta calculation. So that's going to be more consistent moving onward. Either way, it moved from 0.68 down to 0.67 over the quarter. And then taking a little bit of a closer look at that, some people may not care too much for the CAPM model, but I think you should pay attention nonetheless. This is a very interesting aspect of the CAPM model that if you disagree with CAPM model as a whole, you should still like this, because this is something that kind of can prove your own value as a stock picker relative to the supposedly efficient market. Now, if the markets are completely efficient all the time, according to the CAPM model, then you should only be able to earn the returns that the CAPM model suggests that you're able to return. Now, over the last 2 years of weekly data, 100 weeks in the data set, which is what we show here, I had an average return of 0.3% per week, while the S&P 500 had 0.25% per week. Yes, that shows that I'm outperforming the S&P over the last 2 years, and I just showed you that I've been underperforming over like a 3.5 to 4 year period. I've done better over the last 2 years than I did in the first part of my career, which is what I've said I've been doing. I've been making up lost ground for previous underperformance. But either way, if you annualize that 0.3% out, it shows that on an annualized basis, over the last 2 years, I've earned about 16% per year, while the S&P 500 has earned about 13.5% per year. Due to the differences in our standard deviation in the makeup of our portfolio, I have a much lower volatile portfolio than the S&P 500 does, and it comes out that I actually have a beta of 0.67, which in statistical terms is actually anywhere between 0.63 and 0.71. But 0.67 is the beta that you might calculate. So it's a relatively low beta, and I'm outperforming the expectation, or outperforming the index over that 2 year period. So as a result, that basically means that that the CAPM model can't account for everything in my returns, which is shown on the trend line right there. The trend line shows what the CAPM would say my returns are, and my returns are clearly not exactly that. In fact, it also shows in the data set right there that I'm 75% correlated with the index, so I'm obviously not fully correlated with it. The line below that says covariance of 57-58%. That basically means that 58% of my returns can be explained by the CAPM model. But there's still that other section, about 42%, that is unexplained by the CAPM model. So that 42% becomes the y-intercept on the graph, which is 0.13% per week, which is the Jensen's alpha. And that's after adjusting also for the weekly treasury return that you can get over that time frame. So essentially, I'm earning 0.13% per week more than CAPM says I should have earned over that last 2-year period. And if you annualize that out, that means that I actually earned 6.64% more than CAPM says I should have. I should have earned 9.5% if CAPM was efficient 100% all the time, but in fact I earned 16.18%, and the S&P 500 earned 13.53%. So that's my alpha, effectively. That shows that CAPM is not 100% efficient, and that's where my returns are. Now, other people in academics in the different versions of the model that go past CAPM, factor modeling, for example, would suggest that there's other factors that show why I got these returns. Probably has to do with different types of value stocks I picked, perhaps different types of financing I used for my investing, as well as other factors, proclivity for being willing to take on risks more than the average person, perhaps. So, you know, there's other factors that people would argue that's why that's there, and that the alpha isn't necessarily my special stock picking ability, though of course I think that's what it is. So either way, very interesting model. Even if you disagree with CAPM, I think paying attention to your beta and the requisite alpha that you may or may not be receiving as a result of that, through the concept of what they call Jensen's alpha, is a very, very neat concept to use. Though, like I said, it kind of requires at least an understanding of statistics to be able to describe what I just did. So after that, we'll get into some of the details of my actual portfolio in terms of my top positions, as I did with my last video on this. My top position at the end of the first quarter was Fidelity National Financial, and it's still Fidelity National Financial, though the weight has dropped from 14% down to 10 to 11%. I have not sold shares. That's really just the gains coming down pretty significantly. As you can see, my capital appreciation has pretty strongly evaporated, but we're still in the green on it. My expected returns have also come down because I've also trimmed down my expectations for them pretty significantly, even though a lot of expected returns have moved upward. My number 2 position has also not particularly changed. It's still Corsair Gaming, though the returns have been pretty rough for that one in the last quarter. We're down almost 50% now. So, hey, you know, sometimes you make big mistakes on that one. Most of the value for that company was out in the future. So when that gets repriced accordingly with discount rates, well, then that's the type of company that suffers. And well, that's on me for going so heavy into that one. I'm not selling it. But that is just what it is. I've readjusted my assumptions accordingly, and that's just how it's going to be for now. And we'll keeping an eye on that for the next few quarters and year, and maybe we'll have to adjust things further, and maybe we will eventually trim it. But for the time being, I feel confident that they can recover. In third position, at&t, also not particularly shifted. This has to do, I do have a much larger position in it, which it's called my third position, even though you might think that makes it my number 1 position, but that has to do with some interesting dynamics that were going on with at&t and their merger spinoff that they were doing with WBD at the end of last quarter. So as a result of that, I did take on a pretty significant weighting of them at the beginning of the second quarter, and I've been kind of slowly been peeling that off. And the changeover in capital appreciation is also kind of an illusion, because the shares adjusted for the fact that we were paid out the WBD shares. And so actually, if you added in the WBD in there, as well as some of the gains I made through some activities related to that involving some options, I'm actually at a net positive on my activities involving at&t. It's just the straight capital appreciation looks pretty bad as is. But either way, like I said, I am trimming that back down to more appropriately size it as the third position, and then we'll see where we go from there. In my fourth position, in the end of the first quarter, it was Biogen, and it's now Alibaba Group. They've actually flopped positions with each other as far as fourth and fifth have gone. And I've actually sold a little bit of both of them in the quarter, but I've sold more Biogen than Alibaba. Basically a similar story with Corsair is that a lot of its value has to do with the future. And so I'm kind of re-recognizing that fact and repricing it accordingly. What with the more value-oriented scenario and interest rates growing up, I'm just accepting that I didn't buy that at as good of a price, but we weren't selling out of the entire position because it still has, I think, some potential somewhere upward. I just wanted to lower my exposure a little bit to it accordingly. And like I said, sort of the same thing with Alibaba Group, but I didn't do it nearly as much because I still think that one has more higher potentials. And then I was happy that I didn't sell as much as I could have, because it also started to make up some lost ground on that front. And so with that, I kind of did already kind of talk about my thoughts related to Alibaba and Biogen, since they're kind of flip-flop with each other. So this is really just the other half of that same logic and thinking. So this is the overall of my portfolio at the end of the second quarter, weighted by cost, which is the way I generally like to think about my positions. In fact, when I was saying my number 1 through number 5 positions, it's usually weighted by cost, not by actual market weight, because that's basically how I think of it, is the amount of capital that I put into the investment. So this is the general order of all of my investments in here. Obviously, not all of them are labeled on the very small ones at the end there, but this gives you an idea of the vast majority of my portfolio. As I said, T is obviously the largest of them currently, but that's just because of a function of the short-term moves I was making in that one, and so that one will come back down into size eventually. But you can see beyond the 5 that I already named, the kind of next ones in the list: Turtle Beach, Valvoline, Meta, Sandfire Resources, Barrick Gold, KB Homes, Buckle, Intel, Hibbett, Jeffries, as well as a position that I have in hedge bonds, which is basically a grouping of bond ETFs as well as a shorting on the Treasury index to kind of give me a hedge position on that. And switching to market weight, to kind of take a look at the same image, but switching it for market weight, not really too major adjustments on that, but obviously you can see that some of the gains in F&F get rebaked back in. You can see the Corsair drops to a much smaller size. at&t also increases slightly a little bit, as well as the hedge bond position was a little bit more noticeably larger as well. But then some of the smaller slices also got smaller because obviously the market dropped over the quarter in general, but it's not necessarily a super noticeable difference between that. Either way, that gives a pretty solid overview, I think, of my portfolio going into the third quarter, and gives you an idea of my exposure to various industries. So that's going to do it for our update on the returns of the second quarter in 2022. If you've made it all the way to this video, I'd very much appreciate it if you could give us a like, especially if you appreciate content like this. It'll help incentivize the algorithm to give us more content like it. And if you're not already subscribed to the channel, we'd very much appreciate if you subscribe it. That way you can get notified whenever we go live to do our evaluations, and we'd love to have your input.